All right, so famous hedge fund manager, Michael Burry made a big bet early in August, right? Earlier in August, he made a bet against the stock market, 1.6 billion, although it was mostly options, so it wasn't a real bet. And that was early August. So if we look at the charts here, this was about the time he made the bet. We don't really know exactly when he did. You could look at the filings, but either way, it didn't work out. And I think a lot of that bet was because we had dropped the previous, resistance or the previous support level. We dropped the next support level and then we marched higher. So his bet is not working so far. And I think this is a big reflection, right? We're talking about the next leg of the bull market here, right? I think we're headed into the next leg of the bull market. And Michael Burry's bet against the market isn't the only one, right? It is seasonality. We're headed into the weakest historical season of the year, September. But now that that's on everyone's radar, market psychology, the market looks forward and you don't get what you think, right? When everybody's looking at that data, the market's going to decide beforehand. We also just had Jackson Hole, and the Fed was, I think, a little more dovish than people give them credit for. So Michael Burry's bet is not working out. Now, my guess is he's going to have to stop out at the all-time highs or some of his position here, right back above the head and shoulders, right? So on a technical basis, you got the shoulder, you got the head, and you had that last shoulder, and it didn't work out. So a lot of people got stopped out. And what you see here on the candle anyways, the biggest candle, right? Why are you getting that big candle? Because a lot of shorts had to cover, right? After Jackson Hole, a lot of shorts had to cover. Now that brings us to the next guy, right? And we're going to get to why the market is going higher also. But going to the next guy, Bill Ackman. So Bill Ackman is also, he's a billionaire. He's a famous billionaire for, in the market. And he's been shorting 30-year treasuries, or he's been shorting bonds in other words, right? And I think both of these guys, both of these big guys are going to have to reverse their bets. For sure, Michael Burry, Bill Ackman has a little better chance that this holds on, but I think he's going to get stopped out also. So he's betting that yields basically climb to 5.5%. So jumping over to the data, right? What do we mean by yields? Well, we'll go to the 30-year yield, right? That's been climbing. This has been crushing the market, by the way. So 30-year yields have been, crushing the market. Now they're coming off, right? They're coming, and he's betting they go to 5.5%. That is a bit. That would be a big. That would cause a crisis to some degree, right? And maybe it does, but we're not seeing that right now. So anyways, coming off the highs, we're now down 5.7%. So he's probably still holding his bet. Maybe he's still holding his bet, but my bet is, right, once you get below this level, I mean, that's it. That's it. Bill Ackman's going to have to reverse. And all of these, this all plays off each other, right? Right now, the S&P's weakness is happening because yields are higher, because the expectation of higher rates from higher inflation, even though we're not actually getting higher inflation, but we are getting, growth, a lot of tricky growth numbers. And we're going to get to the macro data. We're already hitting the technicals here. Michael Burry, Bill Ackman, they're going to have to reverse their bets. And the market is playing out in that way as we speak. And we're, kind of talking about why. So now you have Morgan Stanley, right? You guys all know that, the biggest bear in the market from Morgan Stanley. What is his name? Mike Wilson, right? Mike Wilson is betting that earnings get revised lower, and that is not the case either. Earnings actually are going higher right now, and we might be out of a negative earnings season in Q3, and we'll see how that actually plays out. So Morgan Stanley increasing their price target, and this is just echoed throughout the market. A lot of institutions are increasing their S&P price targets against, very low revisions or very low prices earlier in the year. Now let's get to the macro data. Why is this even happening? Why are we seeing Michael Burry having to back out? Well, we don't know if he actually is. I bet he does. Bill Ackman, why are they going to get reversed here? Well, part of that reason is, so we're going to jump over to the data that just came out, is that right now, good news is bad news. Okay, good news is bad news. And we went over yesterday, all the weakness in the economy that came out that caused yields to actually come off. And now stocks are going higher. The dollar's pulling back, right? But this morning, we had ADP private payrolls. Okay, private payrolls were expected to come in at 196, right? 196K. I don't know. I'm sorry, I'm getting a call there. Hopefully that doesn't mess up the stream. 196K, and that, we actually got revised lower. these jobs are actually weaker than we thought. And if we look at the previous data, the BLS has been saying what? The BLS said, oh, actually 300,000 jobs, we had to revise those off. So the jobs market is weaker than expected. This is what the Fed wants to see, the labor market come into balance, right? No wage inflation. So private payrolls come in weaker than expected. Bond yields, what did the bond yields do today, right? Looking at bond yields, okay? Today, bond yields came lower, right? And usually use the 10-year as a benchmark, but bond yields have been falling lower. Now, they could still go higher, right? But we have bigger, even more important data coming in Thursday and Friday. So we're just tracking it on a weekly basis. That's what we do here. The macro, data, and pair it with the technicals, the also the fundamentals, S&P earnings, what's going on there. So that's what we're diving in here. So non-farm payrolls came in weak, right? And what that really means is it's one more variable on the lever of the market is a weighing mechanism. It's weighing good and bad news and sentiment, positioning, all that stuff. And this is one more lever for the Fed to pause, right? Any chances, this lowers the chances of a September rate hike. So right now, bad news is actually good news. And we can even see that through how the market is pricing in expectations. But first, let's get through GDP, right? So GDP, annualized GDP growth quarter over quarter was expected to come in at 2.4%. That came down. It missed estimates down to 2.1%, right? So we're still bottoming out here. It's still higher, right? The expectation is still higher than the last quarter, but it's not as high as we thought, which also puts pressure on the Fed to pause here, right? Maybe it's not as strong as we thought. And what did we see? Yields come off, the dollar come off, and stocks go up, right? Because that puts more pressure on the Fed to pause. Okay, pending home sales, right? These are basically home sales that are signed real estate contracts for existing single family homes. I don't expect these to be strong for a while because rates are just too high. Nobody's going to sell their home to go buy another home at a higher rate, right? So pending home sales basically frozen. The housing market is frozen at the moment. So all this negative data, it's not like extremely negative, but all this weak economic data points to the Fed pausing, points to the market pricing in better valuations going forward as growth increases. But before we get to that, again, like I said, Bill Ackman shorting the 30-year treasury bills. And so all this weakness is going to reverse his position, because the reason you short the bond market is because you're betting that inflation goes up. And just so you know, when you short the bond market, you're basically betting that rates go up, okay? But rates are only going up if inflation goes up or if growth goes up or the Fed has a reason to actually hike rates. But right now we're seeing that the data is showing the opposite, that there's not a reason to hike, okay? So Bill Ackman, at what point is the pain too much? And I think the pain is going to be too much. Eventually, we're not going to 5.5% unless we get some type of surprise in the actual data, right? Same thing for Michael Burry. Michael Burry, now that's a lot easier to see. He's short the Qs, he's short the S&P, and the S&P and the Qs are on their way to actually breaking out here, right? So this is S&P here, the Qs, same thing. We're above both resistance levels, both support levels. It doesn't mean we're going straight up from here, but the trend is still in place. And we've been saying this, the S&P, the Qs, the NASDAQ, right? The big tech stocks are still in place. And now there's a lot more opportunity for people to get long at this point, right? Now, what does that actually mean here? Now, also another indicator, another technical indicator to look at is going to be the volatility index, right? The vol index. Look at volatility. Volatility is falling tremendously. What does this tell you? That weaker economic data is actually good news. The weaker the data, the less their bets against the S&P 500. That's what this represents. That's what this reflects. The weaker the data, the better. The weaker the data, the less bets against the S&P. So that's bullish. Okay, weaker data is bullish right now. The market changes, and that's why we're tracking this. So we get the VIX down. If you go to the Q VIX, right, which is NASDAQ VIX, back to the lows, okay? Bond volatility, are we seeing any volatility in bonds? No, it's coming off. Why? Because Jackson Hole is done, and what we got from Jackson Hole is the Fed said, hey, you know what? We have reason to pause here, but we don't really have a big reason to hike unless we see inflation go up, which tomorrow we get PCE, and we're going to go over that. Tomorrow we get PCE, which is the Fed's preferred inflation gauge, right? The most important segments to that, right, are going to, and I have it on my Twitter here, the most important segments, let me back out a little bit, okay, are going to be, thought I posted it here somewhere. Maybe I didn't. Well, most important segments are going to be here. We'll just go to the actual economic calendar. The most important segments for tomorrow. Oh, by the way, inflation in Germany's what, like the fifth largest economy, fourth or fifth. Their inflation rate is coming down, right? We got German inflation. It's coming back down. It had a little bump higher, but it's coming back down also. So overall, overall the global central banks or the global economy, inflation is coming off. So we're going to see policies start to shift. And I think that's a bid for risk assets, for equities, even though things might be, slowing a little bit. So before I get ahead of myself, also we have Chinese PMI coming out this evening. I will post on my Twitter when that information comes out, and we'll track. Remember, China is stimulating. They're increasing liquidity as we speak. They're having to cut rates. They're having to, whatever rate that is, they're having to inject liquidity into the markets and, basically bring confidence to the economy, to the market, right? So we're going to get that data. That PMI data is very important this evening. And then we get the EU inflation rate tomorrow. If that drops, hey, the ECB can stop hiking rates. They can also pause there too. So we're going to get that. Anyways, we get personal income, personal spending, core PCE. Actually, I'm going to post this on my Twitter afterwards so you guys can see what numbers we're trying to see. But the most important numbers here are going to be, for me anyways, right? Everybody analyzes the market a little differently. But when I look at the macro, the Fed was clear. We're looking at PCE data, core and year on year, right? Now, the year on year data actually doesn't look too bad. We're at 2.96% for PCE, right? We're close to the Fed's target when it comes to PCE year over year, right? When you go to core, right, jump into core year over year, core still elevated. It's still at 4.1%. So they need more progress. If core does tick up, okay? So right now, the expectation for core is 4.2. It's due to tick up a little bit. If this number tomorrow morning, right, and this comes in, I'll check the time. When this comes in tomorrow morning, if core PCE, all right, the core is, sort of not the sticky part. If this comes in below 4.2%, the market's going to rip, in my view. The market will rip, in my view. Yields will come off. Bill Ackman will have to stop out at some point. Now, we still have more data on Friday, but it does roll the can down the road for them to make a decision here, right? So 4.2%, we're looking for something beneath 4. I mean, anything under 4% would be great, right? But anything below 4, if it gets above 4.2%, then we're going to see from this data, CME data, that the market's probably going to correct because we're going to see the chances of a rate hike go up. Right now, the chances are at 11.5%. So the chances of the Fed hiking rates have gone down after this morning's data. They've gone down after this morning's data. So we need to see, okay, well, what about tomorrow's data, right? And that's why the market's going up, because yields are coming off. And this is like a domino effect. You get yields come off, right? You also have the dollar, the big macro force, starting to come down, right? Inside that trend that we've been identifying, right? And as the dollar comes off, once we get it below 103, that's kind of, the first leg lower. Under 100 is the second leg lower. That's pretty much a big confirmation that this is risk on at that point. But 103 has been the 6-year level. That's the last 6 years of price action for the dollar. That's a big level. And that's all going to be determined on, do rates come back down? Do long-term rates that pressure mortgages, that pressure risk assets like crypto and Bitcoin, did those start to come off, right? So that's why we're looking for that data coming in tomorrow. Now back to it, core PC is at 4.2%. But like I said, year-on-year PCE, and I'm not too worried about personal income or spending. I don't think consumers are actually, spending more. From the coincident data we've been seeing, consumers are actually spending less. So we will check out those numbers. But on a year-over-year basis, straight PCE, right? This includes energy. This includes food, I believe, or maybe it doesn't include energy. I actually got to look that over. I'll figure that out. But either way, PCE is due to come in at 3.3. So the consensus is even higher, versus the previous print. If this comes in actually lower, right? If we come in at 3.2 or 3.1, the market could also keep on ripping. Or maybe the market, the market is a lot of psychology, is actually pricing in a better than expected number, which is usually the case. The market typically does price in, positive data before it actually comes out, or negative data before it comes out. So it bids up or it sells off beforehand. And then when we get that data, you see how the market reacts to that data to see, okay, are we going higher? Now, my thing is, it's pretty simple. If yields come off, then the market is going higher, okay? So that is tomorrow's data that we're looking forward to. Now, what are the reasons why these guys get short, right? What are some of the reasons these guys get short? Well, earnings revisions, right? So check this out, earnings revisions, okay? And there's a couple things that are going to move the stock market here. Also crypto, we're going to talk crypto. There are a couple things that move this market. It is earnings, right? The earnings outlook going forward, and it is policy, right? Monetary policy is at a point where it's starting to flip. We're getting to the end, right? Rates rates also factor into that, but earnings are on their way higher. You can see right here on the bottom, the trend for earnings revisions being revised up, meaning that analysts and economists are saying, oh, okay, well, you know what? Okay, these earnings might come in better than we thought, right? Better than feared expectations. We've been talking about this for a while, is going to lift, is going to be one variable that pushes the stock market higher. That doesn't mean every single stock, right? Nvidia, all the big mega caps, I think they're going to catch another bid here because they do have the most pricing power, right? When inflation is elevated, when growth does slow, they can still grow, which is why I think they're still going to do well. We see Tesla finally breaking out. We called that back at 215. Okay, it's oversold. Now we're bouncing here. Now it's making a move higher. So we expect the cycle to go back up, right? Either way, you get earnings revision, S&P 500 going up. So that's one catalyst, okay? And if you want to look at it another way, stock prices were declining. So this was a little further back. Stock prices were declining in the dark blue, right? While earning estimates climb. That is a bullish divergence. And on a technical fundamental basis, it's a bullish divergence because what you're getting is stock prices are falling. They're correcting seasonality, whatever you want. 30-year mortgages are up, rates are up, the dollar's a little elevated, right? And at the same time, revisions are going up. So eventually prices are going to catch up to that, right? That's how I see it. That's my opinion, right? Don't take it as fact. That is how I see the market anyways. So going forward, what I'm thinking here is going forward, the pain of being out of the market will get worse in Q4. And there's a couple reasons why. So for one, all the Michael Burry shorts, I know they were shorting, they got faked out. It was a bear trap on that reverse head and shoulders, or no, on the head and shoulders, it was a bear trap. And I think we just keep trending higher, right? Here's why. The pain's going to get worse. First of all, earnings growth rates are rising. We've seen that, okay? We're seeing that. Maybe that changes, and then we'll factor that in. Then we'll come back to the table, right? Fiscal boosts are set to be in the fourth quarter. So the Inflation Reduction Act, okay, the CHIPS Act, that stimulus doesn't start hitting until Q4, right? So that I think that might be part of the reason earnings are revised up. But who benefits from that most? Well, technology companies, right? Nvidia, Tesla, one of the blue chips anyways. There's other companies who are going to benefit from that, but you're going to get a boost here. Maybe even ENPH, right? ENPH, which is, why can't I think of their name? Enphase. Enphase is extremely oversold, right? This might have a bounce here. I'm not advocating for it, but I am keeping my eye on it because the Inflation Reduction Act does help solar to some degree, right? So fourth quarter boost, earnings are rising, and then peak yields. If we get the yields rising, 10-year yields rising because bonds basically getting sold off, pushing yields higher, pushing real rates higher, right? That's actually been hurting Bitcoin. That's been hurting the Qs. That's been hurting small caps and companies who aren't necessarily profitable but are higher growth. I think we're at the peak in yields. I think we are at the peak in yields. So far, we're getting rejected. We'll come back to the table if that does change, right? So now looking at Bill Ackman's bet, okay, he's betting that yields go higher. Why is that not the case? Well, right now, most of the reason yields have been climbing is because of the treasury issuance, meaning the government is creating more supply of U.S. treasuries, which is basically debasing the bonds, right? Debasing the value of your bonds. If you create more treasuries, if you create more dollars, right, out of thin air, whatever it is, create more debt, the value of that debt, the value goes lower. So bonds have been going down. But as we've seen in our other tools, and let me see, should I reverse here? I'll show it on another slide. What I've been seeing is that there's a lot of cash that is parked at the reverse repo. Okay, this is a little complicated, and that cash is leaving the reverse repo and it is buying up those treasuries. So it's actually eating up the capital that the bond market needs to get eaten up, right? The more that capital leaves the Fed or leaves the reverse repo at the Fed and comes into the market and eats up those treasuries, rates don't go higher. They cap rates essentially. Now, do we know this definitively? No. It is basically, you're looking at the market, you're saying, okay, what are participants more likely to do? They're more likely to buy those new treasuries that are being supplied because they're getting an incentive to do it. They're getting more yield on those treasuries. They're getting a higher yield at a short rate. So I think rates are capped there, right? You're also seeing huge US bond inflows into TLT, right? A lot of people are buying bonds for a good reason. The consumer is slowing down, right? The economy is not speeding up at a fast pace. Consumers have been spending a lot. A lot of that is backward looking data, but we do know with, student loans coming back online, we do know that savings are kind of, coming down. Low end consumers anyways are probably going to spend less. The retailers have been showing us that, right? So a lot of that spending is going to come down. So people are buying bonds just in case there's a global recession, whatever it is, you're going to buy bonds. Plus bonds are on sale right now. You're yielding on the 10-year, you're yielding what? On the 10-year, you're yielding 4%, which has been the highest we've seen for a while, right? 30-year, even more. So yes, the bond market might be hurting people who hold debt, but savers, right? They're going to make, well, let's not get into that. It's going to be a little complicated to go into. So getting back to it, that's why I think yields have peaked. Also, inflation, the most important component to yields peaking here is that inflation has peaked. Okay, and we're going to see those numbers tomorrow. We're going to see the Fed's preferred inflation gauge, which is also lagging, right? And inflation has peaked here. The biggest components to inflation we always talk about are going to be the demand for oil. But I know that's not core, and oil demand is set to go lower from my view, from what I'm seeing. There's more supply coming online. A lot of traders are betting it gets above 83.50, right? And we look at the technicals. That's been the where's crude oil at? That's been the big resistance level. So I don't think we get above that level. Okay, there's no way. If we get above it, risk off, right? That is the truth. If it gets above it, yields probably start to climb again, and the dollar probably goes up. And then it really is going to come down to actual earnings having to be revised up or having to be better than expected for the stock market to go up. But right now, if oil stays where it's at, if inflation cools, if inflation cools. And it is cooling, right? And the low end consumer stops spending so much. So consumption drops a bit in services, right? Going back to school, whatever it is, then you're going to see PCE come down slowly. And we're going to track that, right? Also, rent, and Powell talked about this at Jackson Hole. Rent prices are in the pipeline. And what that means is rent prices be in the pipeline. And I have a chart of this. Let me pull up that chart for some of you guys who are more visual. Okay, rent prices in the pipeline. Where are we at in the pipeline? Pull it up here. So shelter prices are a component of housing and rent, right? And housing is in trouble obviously because rates are, much higher. So the cost to own a home or to take out debt is going to be very expensive. But when it comes to rent, you're not taking out here it is. When it comes to rent, you're not taking out a mortgage, right? So what that kind of tells us is that these rent prices have been falling at a much faster rate versus the CPI number. And that is because home builders, there's another chart on that. If you're watching, by the way, follow the newsletter. If you want to be up to date with all these charts, it comes at the end of the week. The newsletter every Saturday, that's going to be pushed forward. It is free. Check it out. Stay up to date with the market, at least how I think. I'd appreciate it. Jump onto the YouTube, like, subscribe. Don't forget to hit the like button too. Double tap the screen if you're on TikTok. I would appreciate the likes. Help me with the algorithm. It's definitely trying to get bigger here. So anyways, rent CPI, right? That's coming in the pipeline. And what that means is we see in red that it's at 3.5%. So Zillow rents, which is a real-time indicator, are much lower than the actual CPI. So eventually that CPI, it's about a 12-month lag. Some say 18-month lag. That CPI is now starting to roll over. You see it at 7.9. As it rolls over, that's going to push CPI lower. That's going to push core lower. So by basically, if you're thinking about gravity, these are all pointing lower for core inflation. So going into the fourth quarter, yields should be lower because the consumer is slowing down. The low end consumer at least is slowing down. You're getting CPI starting to come down in the rent, and home prices, like, they're not accelerating. The home price inflation, it's disinflating, but the prices are still climbing. So that's a different dynamic there. But when you look at home builders, they're building the hell out of multifamily, right? At a record high. We're seeing home builders build multifamily, build apartments. That brings down rent in general. So, prices are going to come down for shelter, and that's going to push peak yield. That's going to push bond inflows to increase, right? Treasury issuance is going to be taken care of to some degree. And plus, all that treasury issuance that the Fed, or I'm sorry, that the U.S. Treasury is creating, is they're creating debt to do what? To spend it back into the economy. So either way, you're going to get a stronger economy in the fourth quarter. That fiscal boost will come online, and earnings growths are starting to go up. The biggest risk here, okay? So let's not go without risk. The big risk is there's a geopolitical event that pushes oil prices higher. That's what sort of caused the big sell-off last year was when oil spiked because of the invasion of Russia into Ukraine, right? So geopolitical risk, that's there. Any type of black swan event, that's there. China, right, is a big cyclical factor for the global economy. They're the second biggest economy on earth, and they're starting to print. They're starting to cut rates. So that is going to continuously fuel the markets. And this is why I think your biggest beneficiaries here, right? And this is my opinion. Obviously, there's a lot of plays out there, but when I evaluate the market, what I see is, well, Tesla is set to go higher. You got full self-driving definitely coming online. There was today, they had basically the NHTSA, or let's just put it this way, the regulator is now asking for more data from the full self-driving. They're getting ready to pass FSD. FSD is around the corner. Full self-driving regulation is down the corner. And I'm not saying there's going to be full self-driving on the road tomorrow or next week. But as far as stock prices, right? Oh, I'm still on that chart. Let me take this off. As far as stock prices, as far as how the market actually works, it's going to look forward. It's going to look forward. It's going to not predict, but it's going to buy into, okay, now everybody's been doubting Tesla as usual. Now there's a big move higher because it's not just full self-driving. It's the energy storage. It's the solar, which is all going to get a boost from that fiscal policy, right? And so I think Tesla has a big advantage here into this market. Plus the technicals are beautiful. Let's jump over to the technicals, right? It is trending higher. It's broken all the technical resistance levels, and it's just trending higher. That's a clean trend there for Tesla, right? So that's moving higher. You hear all the news. There's a lot of news where you can hear what's going on with Tesla, but for the most part, you just got to know the trend's up. It got oversold. It is bidding up. Right, I actually took some off yesterday. I still have some more calls on there because I think this thing is just going to keep trending higher, right? Excuse me. Now the other big catalyst, right, is going to be crypto. This is going to be a very big catalyst. Basically, the courts are now ruling in favor of Grayscale. I know you probably heard this already, but as this continues, right, as there is no more excuses, and this is not a promise, but as there's no more excuses to retain the Bitcoin ETF, and the Bitcoin ETF has been the biggest catalyst because what it does is it unlocks going into the technos, it unlocks, the $35 trillion retirement system. It unlocks a lot of hedge funds who actually want to get long Bitcoin, who just won't do it because they don't want to lock in private keys. They don't want to buy Bitcoin futures, right? So the crypto narrative is coming, and we haven't even hit the halvening cycle yet. And that's going to be a huge catalyst. I think, obviously Bitcoin's going to outperform. Another thing to think about, volatility is very low for Bitcoin right now. This is the lowest volatility it's had for maybe, I think, 2 or 3 years. Also, the longest bear market in Bitcoin's history. What does that tell you, right? Once you get to the end of the bear market, you're nearing closer to the beginning of the bull market, right? So that's kind of the fundamentals. That is kind of the technical outlook for Bitcoin. 25K has been the biggest level. It's about 5,000 above the all-time high from the previous cycle, right? And that's a clear technical signal there, or I'm sorry, technical level at 25K, right? Ethereum also looks really good. I mean, this is not a whole crypto masterclass, but I think Ethereum outperforms Bitcoin on this cycle. And you know how I track that? ETH to BTC, ETH to BTC, giant wedge pattern, dragon wedge coming from the lows, right? So keeping track of that. I mean, that thing has been wedging for a while. That breaks out, you're starting to get movement against BTC, or you're starting to get ETH start to gain. And there will be Ethereum ETFs coming out at the same time, right? So, getting back to it anyways, looking at the long term, or looking at what's going on here. So the US 10-year treasury, right? that's starting to ease. If this continues, we're back into a bull market, right? The second leg or wave two FOMO back online. But the bear case is that maybe inflation does come out stronger. Maybe it just sticks on this trend. Maybe 10-year yields don't actually collapse. Maybe they just keep consolidating. They break out in the second half of the year. That's definitely a possibility, which is why we have to track the data. And we have to not only track the data, but the psychology, the positioning of the market, right? Who's going to be positioned in this market? Now, another factor here is liquidity. And we talked about this yesterday. Global liquidity is starting to pick up. And that is because most of central banks, 25% of central banks from zero, are their last rate decision was a rate cut. So rate cuts are starting to happen. I just saw today, I believe it was Brazil, and their PPI, their producer price inflation, which leads inflation, was like -17. Okay. Now, what does that tell you? That they're in deflation mode, so they can print. They are going to influence the global liquidity supply, which influences risk assets and global equities, right? The U.S. stock market is essentially a risk asset, right? Maybe not compared to crypto or to other tech plays or small caps, but it is a risk asset compared to bonds, compared to U.S. dollars, right? So for the most part, equities are going to catch a bid as global liquidity turns up. And I'm probably going to show this chart tomorrow, but it is all the liquidity indicators that I'm looking at versus the S&P. And now that they're just turning up, the S&P bounced. So that is very interesting. That's an interesting backdrop when I take a look at it, right? Now, again, the dollar collapsing is always a big factor here, the dollar collapsing. And we're going to take a look a little at the technicals. I think we finished pretty much the presentation there, right? Copper's coming down. So Q&A, if you have any questions, let me know. We'll do some Q&A. If you want to challenge my view or you think otherwise, or you want me to do some technical analysis, let me know. We went through 30 minutes. So I appreciate you guys liking the live, the likes, whatever. Just throw your questions out if you have any. There's never a dumb question, really. And I'll try to answer that the best I can. And while I'm doing that, I am going to take a look at the market breadth or the S&P technicals. Actually, let's set these technicals up for the S&P 500. Where's our next resistance level? All these turned yellow because it pretty much bursted through the rest of the levels. Okay, let's go comment. There we go. All right, so let's draw that out. Okay, so next level is probably all-time highs. It's probably all-time highs. We're at 4. Man, that was a quick climb there, but it's probably 459. I mean, some people are going to call it 460. So the next resistance for S&P, let's just call it 459 to 460. Big move. We might take a couple of weeks to actually get there. It's not going to be immediately, maybe it is. Who knows, right? That depends on how the market responds to the incoming data going forward. And as a matter of fact, I think I have this up here. I know I put that data out. Here it is. I'm going to go ahead and just post this on Twitter. All right, here we go. So I'll post it on Twitter later. For now, I'm going to pull up what we're looking for tomorrow really quick. All right, because this is going to depend on the levels. Most important data for tomorrow morning. Okay, PCE. Let me take myself off. There we go. Nope. There we go. All right. So PCE year over year. These are the two things you want to look at, right? Jobless claims, they've been whatever. That's not going to make a big difference. Jobless claims is a layer that's going to add on to how the market moves depending on the big prints, but we do know the Fed is looking at PCE prices, right? You can look at month over month. That's going to also depend, but that doesn't give you the trend, right? Month over month is the immediate. It's a little more, they call it coincident data. It's what just happened. But the year over year is giving you a trend, and that's typically what the market wants to look at, the actual trend of inflation versus the prior year. We don't invest month to month. You invest over longer periods of time. If you're a trader, it may be a little different, right? So we're expecting, 3.3%. I think that's a really good setup because if it does come in lower, that gives the market reason to bid up. So I think if we come in at 3.3, right? The market maybe trade sideways. It expected a pretty good PCE number. Anything lower than that, towards the 3%, which was last month, shows that inflation is cooling, right? And then anything below 3%, I think the market just takes off. You go to core, right, which comes out at the exact same time. And the same thing, anything above is going to be bad. Anything within line, market probably trades sideways, or it could trend higher throughout the day. Anything below 4% is going to be very bullish. Fed Collins speaks tomorrow, so we get another Fed speak, and he's going to, that's going to be huge to look at too, because his comments on what he just saw is going to also guide the market, right? His comments sort of looking into what the Fed is thinking, right? So I'll have that posted on Twitter when I'm done with this actual feed here. So let's get back to the technical charts here. So that's what you're looking at, right? That's a big move higher. Now, everybody thought we would be rolling over. Look how close we are to all-time highs. The S&P now, right, from all-time highs is 6%. That's not a big move. That is not a big move, which is why I think we're going all-time highs this year based off what I'm seeing. As long as inflation comes down, growth somewhat has a bid. The Fed pauses at some point this year, and I think they're going to pause in this meeting. I think we go higher, right? Going to the Qs. What is your next resistance level for the Qs? It's going to be 388-ish, 388 to about 385. Okay. Now the Qs might start actually ripping against the S&P because I think tech finds another bid here. Very possible tech finds a bid. Now, how close are the Qs from all-time highs? About 7%, 7.5%. Okay, so the Qs are close to all-time highs. What about SPX? Oh yeah, this is just SPX. We're in the trend. We're grinding higher. Equal weight looks pretty good. So you have all the equal weighted average. This is market breadth. They're doing pretty good. The Dow value stock still moving up. You're getting market breadth. IWM, small caps, they've actually been struggling. They sold off the most. That was a big sell-off from the highs. I think S&P sold off 5%. We got 8.5% sell-off for the small caps. Equal weight S&P. So if you ever have trading view, RSP is the equal weighted average, which there's been a lot of inflows to this ETF because people don't want exposure. When I say people, rich people or people who are not looking for high growth, they're looking for, or just clients in general are looking for exposure, not to the big magnificent seven. They probably already have exposure to that. So they want a little more exposure to the other 393 companies. They want equal weighted exposure. So we are seeing that play itself out today. Looking at the ETFs, what are we seeing? XLF financials. Financials are flat, I would say. KRE is actually negative. That's interesting. So that could always be a risk to the market. XLE energy's up. And if you did miss if you missed the stream, it's on YouTube. You can take a look back on YouTube. The stream will be on YouTube. The opening, where we went over the actual report. Now we're looking at the technicals here and answering questions if you have any. I actually did want to take a look at ENPH though, because like we said, there is some catalyst coming into the solar stocks pretty soon here. They're at the lows. You can see that ENPH had, I'm going to put this on the weekly chart so you can see a little clear here. Enphase had a lot of support at what, you could call it 110 to 120, right? Back in April of 2021. Actually, that's not the tool I want, of 2021. So about 3 years ago, right? Then you had that same support, right? It went up, I mean, what is that, 100? It went up almost 100%, came back down. Another support here, 2022, January. So this is when the market sold off, right? And now, interestingly enough, right? This is something to keep in mind. The bear market started January of 2022. Am I getting that wrong? No, January 20. That's when the market started to peak, but Enphase actually went higher. Why? Because the inflation was energy, and solar did benefit off that. So this is also a good hedge if you think inflation comes back on the energy side, right? I don't think so. I don't think it's the same type of hedge. It's not the same macroeconomic backdrop, but you do have support here, which is the main thing I'm pointing out about 120. You're also getting that RSI divergence, bullish divergence. It is holding straight here. The RSI is holding sideways while right? It's holding sideways while you get price really falling apart. So the last time RSI was down here, we bounced from, we got this low. This is even lower too. We bounced from 113 up to 195. I'm sorry, to 113 to 330. So it went up almost 200%, almost 200% when the RSI was this low. Can it keep falling? Sure. Which is why you have your stop. Where's your stop at, right? Under 120. Maybe you try to get in there at 120, try to hold it, whatever you do. Now, the catalyst for EMPH is going to be, man, that thing really fell off a cliff. So I'd be a little careful there. You really want to see a consolidation. The catalyst is going to be that infrastructure. I'm sorry, that Inflation Reduction Act money coming in Q4, right? Coming in Q4, and the market typically bids up ahead of that stimulus, not when it happens. It usually bids up ahead of that, and then it finally corrects after it's actually happening. So I'm looking out for that. XLK, we got XLK. This is the tech. Dang, this thing is almost at all. This thing made an all. I didn't even realize that. S&P Technology already made an all-time high. Wow. Okay, that's interesting. Did not know that. SMH, right back on the trend, right? This is semiconductor, the semiconductor ETF. If you don't want exposure to NVIDIA or AMD, that's what that is. Communications, I'm just looking for something different, some type of divergence. What are we seeing here? Biotech consolidating very tightly. That's going to be a nice breakout wedge when it does happen. But biotech is, those are risk assets. They need lower rates. Most biotechs are not profitable. Consumer discretionary, starting to move up. Staples, sideways. Those are your defensive stocks. They're not really doing much. Retailers, now keep your eye on retailers. The ETF, if it just moves sideways, you're probably going to get a weaker consumer. This is a good barometer for what's happening with the consumer also. Utility selling off. What does that kind of tell you? This thing is breaking down. I think it tells you that the safe trade is not on right now, right? Nobody wants safety. Utilities typically grow at the same rate year round. They're not really sensitive to interest rates, and they're just moving lower. So I think this is a risk on environment is what you're seeing there, right? Real estate, home builders might be back online. We'll see how that plays itself out. And if you are losing your comments on TikTok, just go ahead and switch over to YouTube, and I can see your comments stick. Some of them get lost. What up, Ace? I see you in there. Know your picture. Meta, Google. Oh, and also you have the Apple catalyst, right? You have a lot of catalysts coming in. Apple, the iPhone coming out. Apple will probably bid up and then sell off into the iPhone. But either way, it's going to be a refresh of more revenue, right? More revenue prospects going forward. Better, possibly even better margins. What up, Hassan? How you doing? Haven't seen you for a while. Bulls are back. The Bulls are back. Teladoc, I'm bullish on Teladoc long term, although it's been a lot weaker than I thought it would be after that earnings report. And a lot of this, again, is interest rate are just too high. Interest rates are just way too high, right? Roku has actually been doing well. Palantir, I know Palantir got a boost from, I think, Bank of America. What up, Fibonacci? Poppy, what up, Ace? How you guys doing today, man? How you guys doing? Hey, watch back like the first 10 minutes. I got all the data on the first 10 minutes, unless you already heard it. That's what we're kind of going over what the Fed is doing. Check out my Twitter too. Also, link in the bio to get all the charts that I'm focused on to try to get the story, right? What is the story happening in the market? What is the story going on here? Why are stocks going higher? It's basically because the data, good news is bad news today, at least at this period of time. And the data is pointing to weaker growth or a weakening economy are not as strong as we thought. The jobs numbers have been pretty weak. And if that continues, bond yields come down. That helps valuations, right? For stocks, that increases stock valuations. That's one way to think about it. Open Door, wow, Open Door showing that second opportunity there on the bounce at what, $3? And this is the weekly chart. I'm actually going to switch to the, oh, you know what? Check this chart out for Tesla. I know I always talk about Tesla, but check out this big bar. Check out this big capitulation bar on the monthly chart. That's the biggest monthly. I mean, if we clear the month of August, that's the biggest capitulation. If we get above 260, I don't know if we get above 260. Let's see. No, because we have like 2 more days, so we probably don't get there. But that's a big sign of capitulation, right? For Tesla bulls, and mostly because again, full self-driving, the narrative is coming back. You got Cybertruck in Q4, which markets front run that, and you have Cybertruck in Q4, and you have the licensing of the supercharger network, right? Supercharger network licensing, and there's just a lot of catalysts for Tesla going forward. And that full self-driving one is going to be huge. Maybe it's a falter. Maybe it doesn't come out as soon as people thought. But either way, just the progress alone from regulation is going to push Tesla even higher. Just the progress from the regulation. Nvidia surprised me. Nvidia closing yesterday at the highest level. Can it do it again today? Right? Can it do it again today? So Nvidia bidding back up. And really what you saw was that earnings came in and the market moved higher on earnings, right? Q2 earnings. And then it sold off halfway through after Apple reported. And then at the end of the earnings, now they're like, oh, well, there's not really much to sell off from. There's not really big. The biggest risk is that rates keep going up. Now we're seeing the macro forces turn in the positive direction for stocks. We are seeing that pull or make its way through. Zoom, and yeah, let me know if you want me to look at some technical. Zoom is still on trend, but they had a pretty good actually earnings. They have a lot of cash flow, but Wall Street just doesn't like Zoom right now. It just doesn't like Zoom. Zoom needs something else. This could be a good buy though going forward, which is why I'm looking so far out when it comes to Zoom. If ARK does take off, Tesla pushes ARK up, you really need rates to come down though, which I don't know if is even going to happen anytime soon unless inflation really collapses. For these to catch fire, you need rates to come down, or you need some type of narrative or some type of deal, some type of catalyst. But rates for these riskier assets need to definitely come back down, and we're not getting that. Let's see, Netflix, Microsoft, Netflix starting to bid back up. AMD was forming that gigantic wedge. Now this is going to be beautiful when it does break out. AMD with the huge, right? I mean, this is a monstrous descending flag channel. This is a bull flag. This is a gigantic bull flag from AMD. It's pretty strong here. I mean, look, it's now from, if you look from the lows, I mean, maybe it has a little more room, right? Maybe it has a little more room to go, but it's basically bull flagging into the uptrend. So if there wasn't a beautiful, if I hadn't seen a beautiful chart, this is it right here, AMD. It's just very frustrating stock to actually trade, which is why you have to look at that RSI. Look at the RSI. It's almost oversold. Once it gets oversold, right, and the market really starts to make highs, which AMD will probably take off before that even happens, then we'll break out, and it probably goes to 150. Probably goes to about 150. So when it moves, it moves. All-time highs, who knows? And this is all considering that the Fed does pause in September, that inflation does make its way lower, that the dollar continues to roll over, right? That bond yields ease further, that earnings revisions go up into Q3 for Q3 earnings, and that GDP stays afloat. And you're getting that fiscal stimulus coming online in Q4, right? A lot of catalysts here. Let's check out On. Whoa, On had a big pullback. That was a good buying opportunity though. Very good buying opportunity for On. Let's see that trend. This thing just has a monster trend. Anytime it pulls back into the trend, I mean, it's pretty much gold. Yeah, On looks pretty good. Let's remove this. Let's throw those moving averages. I'm thinking it's moving off the moving averages. Looks like it's holding that 100 daily moving average. You got some support or prior resistance at 95-ish. So if we can get On back to 95 and bounce, could be a good entry there. It's still in a bull trend though. It's still moving higher. You got the double bottom right off the 100 daily moving average. And you know what? That actually brings me to S&P. I think we're back above. Yep, we are. We're back above. Let me get off this bull stuff or this bear stuff. we're back above the 50-day moving average, right? So we slipped an average. Okay, wow, we slipped an average. The last time we actually did that, so on semi looks great, Asan. Last time we slipped that average, and the reason I always go back to S&P and the Qs, because this is going to carry the market. If you're looking at a particular stock or asset, you want to look at what carries it. And if the overall market goes up, you don't want to be trading or getting long when the overall market is weak. When the overall market is strong, then and you're bullish, then you can expect your asset or your stock, whatever it is, your company, to also outperform, right? So you want to look at the overall market first. So the last time we slipped the 50-day, okay? The last time we slipped the 50-day, we actually came below the 200, right? But we had some bullish divergence here, so that doesn't really make a lot of sense. But when we came back above it, I mean, that was the consolidation before we started ripping above 420. That was the first FOMO wave. So I think just by looking at it, we could be consolidating between 458. The market is moving up pretty quickly, right? So I think it's trying to price in better than expected news at the moment. We could be consolidating maybe and tap against 459, 460 for another month while everybody thinks, oh, September is the weakest month of the year historically. That is true, but Bespoke came out with some information that said that's not actually true when the market's already up 10% for the year, right? So what does that tell you? That yes, September is the weakest month, but it's not necessarily a reason to sell. It's a reason to load the boat. And I think we're going to continue to see that, right? Which is why, Michael Burry is probably, well, he just has options, so he probably doesn't have that big of a position, but he's probably hedging himself definitely higher. We are getting that squeeze. And yeah, we got that bounce based off liquidity going up, which is very interesting. This right here, I know this is a lot of information on there. Let me take off the moving averages, but this Fed net liquidity, or this net liquidity indicator from the Fed, it bounced along with the S&P here. Okay, and what that is reserves. From my research, maybe I'm wrong, reserves at the Fed that banks have at the Fed started to increase. And what that means is as the reserves increase, their ability to loan out increases. And they do loan to each other on a daily basis. So it just means more liquidity, right? And more liquidity in the market also means, it doesn't mean it's going into your stocks, but what it does mean is more certainty, right? Uncertainty is what the market hates, what the market doesn't do well off. When there's uncertainty in the market, it struggles. But when you have more liquidity, more things to back, more variables to back any type of stress to the system, then you do get the market finding confidence and going higher. It usually goes higher on average, which is why it's so hard to be a bear. If you're a bear, you better be a bear when the market is overextended, overbought, and it's been up for a long time. Right now, we're coming out of a bear market. We're not even at all-time highs. If you take a big look at that trend, that anybody would be like, oh yeah, that's pretty bullish, right? It's really hard to be bearish. Maybe in the short term, maybe a couple weeks, maybe a month, maybe it trades sideways, but overall the cycle, I don't think so. And if you've been on here, I've been on TikTok, I've been saying this for a while, and I welcome the other arguments, right? And one of those big indicators is going to be market liquidity coming from China. I see global liquidity turning up. If you are a member of the can't even talk right now, of the newsletter, then you'd know. I'm going to show that market liquidity coming out, how the S&P is pretty much moving with it. And the Qs also. And think about it. If you're in China or you're in another country, you want exposure to U.S. equities. You don't really want exposure to Chinese companies. Not even they trust their own system. Maybe the institutions, because they have a stake in it. But normal people want to own the best performing assets, right? Which is why I think Bitcoin is also going to be moving a much higher from here going forward. I don't know if we had any comments here. Any TA. Okay, in a second here, we're about 54 minutes. We're going to check out the, what is the data on Friday also. We'll take a look at that. Tomorrow we have data, and we already know it's going to be PCE, right? It's going to be core PCE and PCE. That's sort of what the market is looking for going forward. Actually, let me switch over. I'm going to take a quick little bathroom break. Then we're going to switch over to the actual trading charts. Let's do some TA on Tesla, right? Intraday. kind of where the levels are at, because I'm still waiting for that pullback to add to my position. Oops, I don't even have it up here. Let's go to that 30-minute chart. And then I'm gonna look through Twitter to see if there's anything immediately that we can address. Anything on Twitter, anything on CNBC. There was a couple articles that came out, so I'm gonna read through those. If there's no questions or anything, I'm gonna read through those and keep on those technicals, and then we'll end it right there. But let's do that. Let's see, is it showing up? All right, this is Apple. Yeah, Apple bidding up into the new fresh, or to the refresh. See if Apple gets tall. Can you cover crypto? Oh yeah. Let me cover crypto. Yeah, I'll cover crypto also. Give me a small little break, and then I'll cover crypto. I'll be right back. All right, so now that we're looking at this, what I'm gonna do is, um, I'll pull up some crypto articles, and I'll just go over the kind of what's happening right now with crypto. All right, so let's see that price. This is Bitcoin futures. Bitcoin futures really pumped yesterday. Wow. Oh, I need to fix that. Yeah, so just to simplify everything, Grayscale actually, they filed for a Bitcoin ETF way before ARK, way before pretty much everybody who's done it. Who are the other crypto filers? We know BlackRock. We know whatever. So the judges are now ruling in favor of Grayscale. So the whole denial, basically the denial for the ETF, had to be thrown out. So now they have to come up with a new reason. The SEC needs to come up with a new reason to deny the crypto ETF. That could come next week. It could come next month. It could take another year. We don't know exactly, but we do think political pressures are going to be in favor of the ETF coming online, right? Um, so it's tricky. Nobody knows exactly what's going to happen, but we are seeing progress being made there. Now, price action wise, Bitcoin's been in the longest bear market. A lot of hedge funds are waiting for that ETF to come in. They don't really want to touch, exchanges at this point because of what happened, a couple of years ago with Sam Bankman-Fried and FTX. So I think this is the big catalyst. It really is. It's really easy. More progress, the price goes higher. The more SPY is wedging also. That's really bullish there. Um, we could actually see, missing a couple of those comments. No, I don't think we got anything there. So we could see Bitcoin really start to surge if that regulation continues to ease itself. Now let me see if there's any micro details inside of that. All And there's a lot of Ethereum ETFs right in line behind Bitcoin ETFs ready to be signed. So it just comes down to when they actually execute that. Crypto exchanges saw flows of 30K Bitcoin prior to Grayscale SEC victory. There's a lot of inflows coming in, I think. And crypto moves quick. So really, I'm kind of just going over the main ideas here for the catalyst, right? Biggest bear market, low volatility. The shorts did get squeezed. I think literally that big move in Bitcoin was the shorts getting squeezed. So the shorts just got squeezed on Bitcoin. Will they keep shorting it? Maybe, maybe not. They're probably hedging themselves, but I don't think there's really any big news. Robinhood crypto wallet adds Bitcoin and Dogecoin. Interesting. Okay. I don't really think there's any big news. It just comes down to the regulation. What are the next steps going forward? So the better it gets, the closer we get, the better. So yeah, BlackRock filing their ETF almost guarantees it's going to happen at some point. We just don't know when. A Grayscale Bitcoin discount, blah, blah, blah. Oh, you know what? I don't know if you guys heard about Ben Armstrong or BitBoy. If you heard about BitBoy, did he really lose everything? It's actually kind of interesting. I don't know what happened to him. I think he got sued by a bunch of people. So let's see, Ben Armstrong here, and this is S&P price target. Headed into the close. SPY's looking good. Dow's looking good. Dow's actually below VWAP, so maybe not. All right, so yeah, I'm going to read a couple of these things. What happened to BitBoy? BJ Investment Holdings, the parent company of Hit Network, took decisive legal action in removing Ben Armstrong from the company, specifically the BitBoy crypto brand. He's been scamming a lot of people too, BitBoy. I used to like him when I first heard about him, but he was just too scammy. Always, oh, I'm doing this coin, I'm pushing this. I'm like, bro, if you don't understand the coin, you shouldn't be in it, honestly. The difficult decision is in a culmination of a prolonged effort to help Ben during his relapse into substance abuse. Oh, okay. Well, no wonder that dude is streaming every single day, 24 hours. He was a little overweight, and he didn't never looked healthy. He never looked healthy to me. And a lot of times, people, if they're not healthy, they turn to substances, whether it's Ritalin, whether it's whatever it is, to keep them going. As well as, caffeine is one thing, right? I mean, you can overdo it. You just got to stay hydrated. As a reconcile the emotional, physical, and financial damage he has done to the employees of Hit Network and that sucks. So yeah, the fall of BitBoy. You're gonna have a lot of these guys fall because I'm not saying they're in it for themselves. We're all in it to make money, but they get ahead of their skis. They get hyped. They get high on their own supply. Their ego gets a little too pumped, and they start pushing all these scams. So that's unfortunately for Ben. But the full FSD for Tesla is going to be huge. That's going to be huge for Tesla, the full self-driving. Bank of Canada might raise their interest rate again? No way. So we have earnings today. We have CRM, CrowdStrike, Okta. You have all the cybersecurity companies going through earnings today. I think those are going to be good because cybersecurity is one of the biggest threats in the U.S. today to global instability in general. Oh, okay. Here we go. Finally, some FactSet news. All right. I need to see this new earnings data. I was waiting for this data to come out. I probably missed it. 60% of companies in S&P TSX composite have beaten EPS estimates for Q2, which is above the 5-year average of 54%. So we're looking at estimates here, huh? See if there's a bigger article, because I want to see these estimates. This is one of the biggest drivers. Is this Canada? Oh, this is Canada. No wonder. I was going to say, that's Canadian. I don't care about Canadian. I don't care about Canadian markets here. Yeah, I mean, price targets. Everything's about price targets at this point. All right, well, I'm going to jump in. I don't see anything kind of pointing its way out. So I'm going to jump into these technicals for Tesla. Where's the entry point? No, it doesn't look like we have anything there. Zero hedge, check on him. Airbnb bubble, a proposed Labor Department rule would extend overtime pay to millions of workers. What? DOJ, SEC investigate Tesla over secret glass house project? What? There's going to definitely be a lot of volatility going into full self-driving. You should see a lot of negative articles and positive articles. All right, so let's just go ahead and do that. So for today, anything missed? Fed top inflation gauge. We know that came down. Fed pushes for bank regulation, improve liquidity after Silicon Valley. And I think liquidity is improving, watching those indicators. So Tesla, where's Tesla at right now? Taking a step back. Looks like we have a major support. Wow, supported that trend. I think 250 is your support. You got 250 and you got 241. Those seem to be the two levels. Let's take off let's remove the gaps here. Okay. 250. Yes, 250. Yep, that's a very clean support there. 250. Whole number also. You've seen the capitulation into 250. Now that this is done, we can remove this. We're still in that trend. So I think 250. We probably come back down to 250. If anything, if we really break down, then we're looking at, let's remove this. If we really break down, we're looking at 241, I believe. And that might be off of a higher than expected PCE number tomorrow, or very bad jobs report on Friday. And that, that kind of brings me to Friday. We know PCE, we're looking for those PCE numbers tomorrow, but what is coming in on Friday? Unemployment rate. I don't think that's going to move. I think we're going to be pretty steady. We might tick up a little bit, maybe. Non-farm payrolls. Well, we saw that private payrolls came in weaker than expected. I expect non-farm that usually gives you insight into non-farm payrolls. Not all the time, but typically. And non-farm payrolls, if they come out weak, those rates are going to really drop. And you remember the last time rates dropped, that was the banking crisis. Confirmed the bull market. So we get weak. If we get weak non-farm payrolls, labor participation, we want that up. That closes the gap on the wage price spiral that brings the labor market into balance, which is what the Fed has said that he Powell wants to see. Average hourly earnings, that's the one I'm like, hopefully that doesn't tick up too much. It's expected to come in at 0.3 month over month. The last reading was at 0.4. So average hourly earnings, if that is sticky or if it's high, that might be a reason for rates to start surging. Well, maybe not surge, but go up a little more. The year-on-year data is what I'm looking at, and that's been really sticky. So look out for that Friday. And we'll go over this tomorrow, so I don't really need to go over this now, but it's at 4.4. We need to get below anything above 4.5%. Okay, 4.5% average hourly earnings. That signals 4.5% inflation to some degree. You can think of it that way. So that's going to be terrible. Anything below 4.3, very positive. Okay, so 4.5 to 4.2 is what you're looking at. Inside that range, nothing, it probably doesn't really change anything. Above or below makes you a big difference, makes a big difference for the market there. And we also have the ISM manufacturing, which I think is going to start recovering here, because I'm looking at the new orders over the past couple weeks. New orders are picking up, and the ISM is sort of the last big indicator that the economy is starting to pick up again. It's the most forward-looking mechanism for the economy, the manufacturing sector, and I think it's going. I think it's going to be moving up. New orders have been moving up pretty precisely. Now this is weird. You get a jobs report and the ISM on the same day. Friday is packed with a lot of jobs labor data. That has a lot. Tomorrow's basically the Fed's inflation gauge and consumer strength, right? Consumer spending more or less than we've seen. Are their incomes increasing or decreasing? And so the consumer and the Fed's PCE. That's pretty much it that we got for tomorrow. All right, so we're coming to a close on the market. That's it. Hey, any more questions before I close it out here? Let me know if you guys have any questions, any comments, anything to address, and then we'll be back on again tomorrow. Don't forget to like and subscribe. Appreciate you guys. Thank you, Crypto Fam. I see you. I see you guys. Try to come up with the best economic data for you guys to look. Now, look, when it does come to crypto, because for me, I'm really bullish on crypto this next cycle. I think it outperforms absolutely everything, NASDAQ and Tesla in general. We really need those bond yields lower. Crypto only cares, for one, the ETF's the biggest catalyst, but for two, the ETF is a catalyst. Rates are not a catalyst. Rates are more of a fundamental for crypto. When rates come down, it increases liquidity, right? Lower rates, more lending power. Okay, now if liquidity picks up, which I am seeing, I'm going to show that chart tomorrow. I'm going to work on it today. It is showing all the factors of liquidity coming from China and the global liquidity outlook. And you've seen on all the crypto channels that global liquidity is coming down. That is not the case. That is not the case. It is bottoming out. It is bottoming out. And if anything, it's getting ready to start to turn up now that China has collapsed. When global economies weaken, more liquidity tends to come back into the system. And we are getting that bounce there. Let's see if I can move this chart up. No, we are getting that bounce on liquidity. So, ooh, I like that. Let's move this over. And when it's weak, it's weak, right? When it's weak, it's weak. But right now, central banks are printing. They're printing, or they're cutting rates. They're not really printing right now. They are cutting rates. So I think that is the case. I think that's what we're going to see going forward. That's the case for crypto. Growth is slowing. Very bullish market. Now, what are the big negatives, right? I don't always want to just be super bullish, but so far we've been right all year. The big bear case, again, you guys should know if you've listened to me, is going to be oil. Oil prices surging higher, which I don't think is going to happen because you have a lot of supply coming online. The U.S. needs to fill the SPR. They don't care. It's political. Oil prices are political at this point, and they will do everything in their hands to keep oil lower, which means they won't fill the SPR. They will just keep pumping more supply and feeding off that supply. So if you don't get oil materially move up, right, crude, if you don't get crude move up, then inflation expectations just keep falling. The more it moves sideways, oh wow, I had that highlighted. The more it moves sideways also, you get zero inflation from there. Rents are coming in on the backside. A lot of good news. Earnings are getting revised up, very bullish. A lot of people caught off sides here in this big move higher in the market. We got up to 84.65. When was this? Oh, this was August 9th. Okay. Oh, that's right. That's right. We'll see if crude can keep turning its way up. That's the zone for crude. All right, well, no more questions. I'll be on again tomorrow, 2:45 Eastern time. And don't forget to like, subscribe to the newsletter if you want to be up to date with what I got going on there. I also have some fitness stuff on there if you want to check it out. Coming out with what mistakes you're making in the gym that are keeping you from growing muscle, and the top benefits for sauna. We have a fitness channel. Go ahead and check it out. Either way, you guys stay blessed. I'll catch you tomorrow. Stay blessed. Get your workout in. Keep a growth mindset, and we'll be back in the morning. You guys stay blessed. Have a good day.